In this video, I'm gonna show you algorithmic order flow strategies. I'm gonna give you a lot of ideas and examples on how to extract edge and a bunch of other alpha. You'll also understand what is order flow. You could try and replicate what I have and come up with even better ideas than the 30% net strategy over a 28 days period. I'm gonna show you all the experiments I've ran with their results and try and explain them to you so even a baby could understand. Let's go. Okay, first, to understand the order flow I'm talking about, I went to velo.xyz. That's a really good order flow visualizer. If we look at the panes, we have aggregated open interest, aggregated funding rate, cumulative volume delta, spot cumulative volume delta, order books heat map that you can toggle on and off, and a bunch of other indicators such as liquidations, premium, spot tape, whatever, okay? To give you a rough idea of how you would use order flow, let's look at this example. You see, this is a valid shooting star or reversal candle. Okay, so you can have a system for that that's gonna trade mean reversion once the candle is confirmed. You would enter here, put a stop loss above that, just like this, and a target would be whatever, up to this low, okay? If you would trade every candle that looks like a shooting star, you would also trade, let's say, this candle, or this candle, or this candle. And you wouldn't have such a nice trade like this one. Why? Well, one of the confluences you could use is the open interest. If you look at this reversal candle and at the open interest drop, we see a big red candle. It means positions have closed on this candle. We could say it was a shorts that got stopped out and longs that were take profited here. That could mean price has done already something that it's wanted to do at this level, and now it shows early signs of reversal. Or it could just mean a trap buyer or whatever. Okay, it's not the point. The point is that it shows you some sort of confluence, okay, that you can test and see if it yields an edge. For example, if we look at this candle, we don't have such big drop of open interest here. Thus, move is not really tradable, okay, and the mean reverse. And it chops for a bit. That's the rough idea. We also have funding rate, cumulative volume delta, or spot cumulative volume delta. We're gonna dive deeper into them once I show you the results. And watch until the end of the video because the results are really impressive. So I have my own collector running. This one collects data from Binance and Bybit, spot and futures, perpetuals. It collects the order books, the open interest, funding, all of that. Everything that is possible. And basically here I have it all interpreted, okay, visualized for human eye. Very similar UI, right? You see panes, you see open interest, you see funding rate, you see order book depth, and cumulative volume delta. So that means I'm actually able to create algorithmic strategies, use this data, and find interesting patterns or confluences or whatever. For example, order book depth. Sometimes you could have a really outline stack of bids. That could mean a potential bottom. Who knows? I don't know anything, guys, okay? I'm just asking questions. That's what you should do as well. Then I'm gonna implement and backtest it, and then we'll see whether it works or not. Spoiler, some of it works pretty good. Now, let me show you the results, okay? They're pretty good. I created this little dashboard, showing you my experiments and stuff. The basic idea of Orderflow ML Research Hub, that's how I call it. Interpretable, order flow driven day trading research. And the non-negotiables, and here you can see the little experiments I've ran already. We have basic public order flow imbalance queue. It's not even worth discussing because the edge in it is not that interesting. Let me get back and see to trap traders sweep or failed breakout. This one was interesting. Here you can see the results. That shows 4% net increase, okay, 3% net increase over 28 days. That's pretty good. Yeah, I know, too small of a data sample. Every experiment was tested across this 28-day period because that's how long I've been collecting data for. And it may seem too little, but when you have 50 or 100 trades like here across this 28 days, that's a good start. So we'll just leave it at that. I could click over a couple of them experiments. The 01 is the data and microstructure, so it's not much to talk about here. Order flow imbalance threshold rule. To explain order flow imbalance to you and the threshold, look at this slide. We have a basic formula for Q imbalance, which is just a bit size minus ask size over bit size plus ask size. That's a number from -1 to +1. More restant bits than asks means upward pressure, and the opposite means downward pressure. Threshold is the theta sign. That's the number from -1 to +1, which order flow imbalance or Q imbalance needs to cross in order for this value to be valid for our signal. The question is, does a simple OFI threshold rule have positive net of cost expectancy? And including costs, it's really not. Then the interpretable machine learning lift over the rule. That's basically the E1 version, but instead of a hardcore threshold rule, we have a machine learning model that has control over this threshold, okay, in order to improve results. We can see the equity curves here. Okay, some of them are even profitable, but it's not really what we are looking for. Then we have a combination of E2 and C1. This one was tested on 1 minute, 5 minute, and 15 minutes bar. That means we're not looking at windowed order flow imbalance, which also means we're looking at a bigger scale of a move, which is what I'm doing most of these experiments, because trying to catch small tick movements, it's not worth it because the costs for crypto features, they're quite high. Conclusion for this one was a genuine lead, but yeah, still only Ethereum is profitable, and yeah, not that good to be honest. Let's go further. We have C2, trap trader reversal, directional rule. Okay, you see, I don't even have an equity curve for this one because it was not what I expected it. But the idea is, do failed breakout liquidity sweeps give a net of cost reversal? And remember me showing this reversal candle? There are some ways you can read this failed breakout out of order flow data. That's basically what I've done here. Then I had a bunch of parameters here, so I needed to optimize them. So I created a new experiment, which is C2 genetic algorithm. And this one yielded an interesting 3% result over a 28-day period. That was an interesting take, but it could be overfitted. So the one thing that is left is to keep collecting more data and start live testing it. That's basically it. Okay, next one, C3, open interest and price divergence. Unbacked move, such as a short squeeze or a trapped failed breakout, okay, that doesn't have any flows to back it up. Let me give you an example of open interest versus price divergence, aka unbacked move. For example, you see this little trend that goes up. You see open interest consistently goes down. That means while price is rising, positions are being closed. That means market has no interest. Literally, that's what open interest means. Market has no interest in price being at a higher levels. That means it's less likely to back it up. And what's the result? It mean reverts. It could also stall or chop. Result is the same, no continuation. So that's the idea behind this C3 experiment. It was tested on Bitcoin, Ethereum, and Solana. And let's look at the charts. I'm gonna scroll through the negative ones. This one is 6% after the 28 days period, but really, other sample is not promising. But if we scroll down to Solana, 5 minute or 15 minute, these are much better. Basically up and to the right only, and same here. 10% over 28 days period. Yeah, with a drawdown 7%. Of course, it needs to be risk adjusted, but still, quite nice performance. But wait, that's not even the best one. If we look at the C4, which is the footprint reads, to explain you what a footprint chart is, it's a chart that looks similar to this one. It shows the actual buy versus sell volume traded at every individual price. It's been plotted inside each candle, and it turns every bar into these numbers or a map, and it shows the aggression between buyers and sellers. With that, footprint charts can expose absorption, imbalance, and exhaustion, the things that normal candles can't explain. If we look at the results here, pooled 30-minute fade, which means trade the mean reversion side, yielded 36% over 28 days with a drawdown of 12%, which means return to drawdown ratio is 3. That means if you allocate less capital to the strategy, so it reduces your drawdown, let's say to 6%, you would still have 18% return over a 20-day period. Isn't that amazing? It actually is. So, two things. First, obviously collect more data, see how it performs second month, third month, live trade it with the smallest risk possible, which would be $1 or $10 per trade. And yeah, so I would expect second or third month have maybe negative month or close to zero or close to low single digits in order to average down that performance. The equity curve, I really like it. It's literally up and to the right. And the last one is cross-asset order flow imbalance lead lag. That's basically C1, but instead of reading BTC order flow and trading Bitcoin, you select Ethereum or Solana. That idea tries to capture a lag between those assets. Because we all know crypto is correlated. If Bitcoin moves, then Ethereum and Solana is gonna follow, because a lot of algos are actually structured this way. And even the psychology behind it. If Bitcoin drops, you also want to sell altcoins to not hold them indefinitely. Or if Bitcoin goes up, you want to buy crypto that didn't go up. And that obviously drives price to keep that correlation to Bitcoin. And that's basically it, guys. I hope I gave you some ideas. Maybe I taught you something. If you got anything you want me to dive deeper into, just let me know in the comments. And yeah, see you later.